Hello friends, welcome to our channel. In this video, we will simplify how to calculate profit or loss in non-deliverable forwards or NDFs. This will help you calculate the settlement amount in exams or in real life scenarios. So let's get going. Let's first note the following about NDFs. NDFs have two currencies, one without government restriction, which is freely tradable, repatriable, like the US dollar, and the other being the currency with restrictions, for example, the Indian rupee, which is the non-deliverable currency. The initially agreed exchange rate between the currencies is called the NDF rate. For example, USD INR 90 can be the NDF rate. This is a forward rate.
A date in the future on which the contract will be closed is called the settlement date. There is a specified fixing date, which is a few days before the settlement date. The spot rate on this fixing date is used for settlement. For example, USD INR 95 can be the rate for settlement, which is the spot rate on the fixing date. A trader can buy an NDF or sell an NDF. Of course, the counterparty will be doing the opposite. For profit and loss calculation purpose, think of an NDF as having two legs. The first one being the initiation of the contract on the contract date at the NDF rate. The second leg is the closing of the contract on the settlement date at the relevant fixing spot rate. Buying the NDF usually means agreeing to buy the base currency at the NDF rate, which is the forward rate, and agreeing to sell the base currency on the settlement date at the spot rate on the fixing date. Selling an NDF usually means agreeing to sell the base currency at the agreed NDF rate, which is the forward rate, and agreeing to buy the base currency on the settlement date at the spot rate on the fixing date. The calculations are done on the settlement date based on the rate on the fixing date, which is a couple of days before. You must look at the terms of the contract to be sure which currency is being bought or sold with reference to the relevant NDF rate. The settlement is ultimately calculated in terms of the deliverable currency, because the non-deliverable currency simply cannot be delivered because of the restrictions. Hence, if the settlement amount is calculated in the non-deliverable currency, it must be converted in the deliverable currency. Therefore, NDFs help hedge risks related to or speculate on movement of a non-deliverable currency, something that they normally could not easily do because of the restrictions. The trader hopes that the fixing date spot rate will be better than the NDF rate. That is, if a trader buys the NDF, the trader thinks that the base currency which he has bought or agreed to buy will appreciate and the fixing rate will be more than the NDF rate. If the trader sells the NDF, he will like that the base currency will depreciate. In effect, the profit and loss are to be calculated like any purchase or sale transaction. Profit or loss in any purchase or sale transaction is the selling price minus the buying price. Essentially, if the selling price is higher than the buying price, the trader will make a profit, else he'll make a loss. Now, if a trader buys an NDF, the NDF rate will be the buying price, and the fixing rate will be the selling price of the base currency. If the trader sells an NDF, the NDF rate will be the selling price, and the fixing price will be the buying price. In general, the profit or loss will be the notional amount multiplied by the selling price minus the buying price. Here, the notional amount means the amount of currency being bought or sold. This amount is never actually exchanged, only the net settlement is done. For example, if a trader buys 1 million USD INR NDF at 90, USD 1 million is the notional amount. Note again that if the profit or loss is in terms of the non-deliverable currency, it must be converted into the deliverable currency by dividing the profit and loss with the fixing exchange rate, not the original NDF rate. Let's now discuss the differences between NDFs and traditional forward contracts. Also note that the NDFs are different from the traditional forwards in the following ways. For example, suppose a trader buys 1 million USD SGD forward, a traditional forward at 1.3456 today, or settlement after 90 days. Basically, the buyer agrees today to buy 1 million US dollars by paying Singapore dollars 1.3456 million on the settlement date. Agreement is done today. The execution or the settlement is done on the settlement date. The spot rate on the settlement date is not relevant. No money is exchanged today on the date of signing of the forward contract. However, on the settlement date, the buyer will actually pay Singapore dollars 1.3456 million, and the seller will deliver USD 1 million to close the contract by physical delivery of the currencies. The buyer will have USD 1 million in his bank account, and the seller will receive Singapore dollars 1.3456 million. This forward contract may turn out to be a wise move if the USD appreciates for the buyer, else it may be a relatively bad decision for the buyer. This can be checked by calculating the mark to market or the notional profit based on the spot rate on the settlement date. Of course, if one simply wants to hedge or lock in the 1.3456 rate, the trader will achieve his objective. For example, if an importer needs to pay USD 1 million in 3 months and buys USD SGD forward at 1.3456 today, he locks in this rate. If USD appreciates, he will be happy. If it depreciates, say to 1.3000, he will think that he could have done better by not entering into the forward contract. He could have got a better deal by simply buying USD from the market by paying SGD 1.3 million. However, the forward contract helped him lock in the rate of 1.3456 million. If the buyer actually sells the USD 1 million in the market and then receives Singapore dollars, he can calculate his actual profit and loss. The trader, of course, or the buyer, the seller or the buyer, they are under no obligation to do such things. They can simply hold on to the US dollar and the Singapore dollar respectively. In NDFs, on the other hand, there is a cash settlement based on the spot price on the fixing date. It is as if the trader buys the NDF today and sells the NDF on the fixing date for a net settlement a couple of days later. Hence, we can think of the NDFs as having two legs that cancel out for a net cash settlement. Forwards have only one leg, the terms of which have to be agreed today, but settled on the agreed future date. Now let's get back to NDFs. Let's take some examples to explain NDFs. For the first example, suppose there is a USD INR NDF. USD being the freely tradable currency and the INR being the currency with restrictions, or the non-deliverable currency. For example, if you're a foreign investor, you cannot repatriate INR to your home country, US. Instead, you must convert the profit or loss in USD and settle accordingly. The agreed exchange rate is 90, which is the NDF rate. This is agreed at the time of entering into the contract. The settlement date is on the 90th day, and the fixing date is on the 88th day. That is 2 days before the settlement date. The 2 days give the traders time to settle the NDF. Basically, you take the fixing rate based on a reference exchange rate quoted by a mutually agreed party, say the central bank, at a particular time, say 11 a.m. Indian Standard Time, on the 88th day. Based on the rate, the traders calculate the profit or loss and settle accordingly on the 90th day. That is 2 days after the fixing date. All these details are mentioned in the relevant contract. Say a trader buys the NDF today for 1 million USD INR at 90. USD 1 million is the notional amount. This large amount is not actually transacted. On the fixing date, or the 88th day, say USD INR is 95. 2 days after the fixing date, on the 90th day, the settlement will be as follows. Since the trader buys the NDF, he basically buys 1 million US dollar and sells INR at 90 and closes the contract at 95. This is calculated as follows. Leg 1, which is the initiation. Trader buys USD 1 million by paying or selling INR 90 million. Note that he's buying a forward contract which needs to be settled in the second leg. Leg 2, which is the closing, trader sells USD 1 million and receives INR 95 million. The difference is INR 95 million minus INR 90 million, which is equal to INR 5 million. Since the currency he bought appreciated, the trader made a profit. That is, the USD appreciated from 90 to 95 against the Indian rupee. However, since INR is a non-deliverable currency, this INR 5 million profit will need to be converted to USD at the spot rate on the fixing, which is basically the fixing rate. Hence, the trader's profit is USD 5 million divided by 95, which is USD 52,632 approximately. Note that the fixing rate is used for conversion. The trader can remit this amount to his home country, subject of course to the tax, forex and other regulations. For the second example, suppose instead of USD INR, the NDF is quoted for INR USD. The terms are as follows. The INR USD NDF rate is 0.01111, which is equal to 1 divided by 90. Spot rate on fixing is equal to 0.010526, which is equal to 1 divided by 95. The trader buys the NDF for INR 90 million notional amount. Since the trader buys the NDF, he basically buys INR and sells USD at 0.01111, which is the NDF rate, and closes the contract at 0.010526, which is the fixing rate. This is calculated as follows. Leg 1, trader buys INR 90 million by paying or selling USD 1 million. And the leg 2, trader sells INR 90 million and receives USD 947,368, which is equal to 90 million divided by 95. The difference, USD 947,368 minus USD 1 million, is a negative figure, that is a loss of USD 52,632. Since the currency he bought depreciated, the trader made a loss and must pay the counterparty the USD amount of 52,632 on settlement. Now we have discussed buying of NDFs. Let's now quickly discuss selling of NDFs. Suppose all the terms remain the same. In leg 1, the trader sells USD INR NDF, notional amount of USD 1 million, at 90 to receive INR 90 million. In leg 2, trader buys USD 1 million and pays INR 95 million. On a net basis, the trader loses 5 million INR, which is equivalent to USD 5 million divided by 95, which is USD 52,632 approximately. The trader lost because the currency he sold, the USD, appreciated. USD appreciated from 90 to 95 against the INR. In the fourth example, the leg 1, trader sells an INR USD NDF. Notional amount is INR 90 million at 0.01111 to receive USD 1 million. In leg 2, trader buys INR 90 million by paying USD 947,368, which is equal to 90 million divided by 95. On a net basis, the trader makes INR 5 million, which is equivalent to USD 5 million divided by 95, or USD 52,632. Now let's consider a case of a US-based importer, where the US-based importer is expecting an INR 100 million shipment of goods from India in 3 months. The current USD INR rate is 80. The trader wants to enter into an NDF contract to hedge the risk of adverse movement in the USD INR exchange rate. USD INR NDF is currently available in the market at 81. Let us consider a few things about this scenario. First, what is the meaning of adverse movement in USD INR from the importer's perspective? Well, the importer will need to spend USD to buy INR to make the INR 100 million payment in 3 months. If he buys INR today, he will need to spend USD 100 million divided by 80, which is USD 1.25 million, to buy INR 100 million. What if the trader does not buy the INR 100 million today, but decides to buy the INR amount on the payment date 3 months from now? If the USD INR moves to 85, that is, the USD appreciates, he will need to spend USD 100 million divided by 85, which is USD 1.176471 million. If USD INR moves to 75, that is the USD depreciates, you will need to spend USD 100 million divided by 75, which is USD 1,333,334, which is basically more than the USD 1.25 billion at the rate of 80. So the importer is actually worried about depreciation of the USD. If the USD depreciates, he will have to shell out more USD to purchase the same amount of INR. So the trader should agree to sell USD and buy INR at the NDF rate to lock the exchange rate at the NDF rate of 81. That is, he must sell the USD INR NDF for a notional value of USD 1.234568, equivalent to INR 100 million at USD INR 81. Note that this is a bit better than simply buying INR at the current rate of 80. That is, USD is currently at a premium to the spot rate now as far as the NDF is concerned. Let us see how the sale of NDF would benefit the importer in different conditions. Suppose the fixing rate or the spot rate on the fixing rate is USD INR 75. The two legs of the NDF are as follows. Leg 1 initiation, sell USD 1.234568 to buy INR 100 million. Leg 2 closing will be done by selling the INR 100 million to get USD 1,333,334. The net profit for the trader, or the importer in this case, will be 1,333,334 minus USD 1,234,568, which is equal to USD 98765. This is the importer's profit in the NDF. Now the importer will actually buy INR 100 million at USD INR 75 to pay the exporter from India, because the NDF is actually just settled or for a net amount, and that payment which he has to make to the exporter from India will have to be made anyway. Therefore, he will actually spend USD 100 million divided by 75, which is USD 1.333334 billion to buy the 100 million INR. The profit of USD 98,765 in the NDF transaction will help reduce the importer's cost. His net cost for buying INR 100 million will be USD 1,333,334 minus USD 98,765, which is equal to USD 123,4568, an effective USD INR rate of 100 million divided by 123,4568, which is 81. The NDF helps him lock the USD INR 81 rate. Had the trader not entered into the NDF contract, he would have been worse off by USD 98,765, as he would have to spend USD 1,333,334 to buy INR 100 million, an effective rate of USD 75. On the other hand, if the fixing rate is 85, that is, the USD appreciates, the trader will lose money in the NDF transaction because he sold USD at 81 and must buy it back at 85 to close the contract. That is, leg 1, sell USD 1234568 to buy INR 100 million. Leg 2 closing, sell INR 100 million to get USD 1176471. The difference is minus USD 58097, a loss. His actual cost of paying the exporter will be USD 100 million divided by 85, which is 1176471. But his effective cost after factoring the NDF loss will be USD 1176471 plus the loss in the NDF, which is USD 58097, a total cost of USD 1234568, again an effective USD INR rate of 81. Note that in such a scenario, where the USD appreciates, the trader could have been better off without the NDF. He would have paid only USD 1176471 for the INR 100 million. However, since the objective was to hedge, the importer should be okay with the outcome, a locked-in rate of 81. Note that had we been talking about an exporter instead of an importer, the scenarios would have been quite different. So, if you want to calculate the profit and loss in NDF transactions, instead of trying to use a standard formula, simply try to understand the transaction. Basically, whether the trader would sell the base currency or buy the base currency in the NDF to achieve his objective. His objective could be locking in an exchange rate or making a speculative profit based on his market view or whatever. As discussed earlier, if the trader sells the base currency, he would be hoping for its depreciation. If the trader buys the base currency, he would be hoping for its appreciation. Break the NDF into two legs. If the trader makes more money in selling than in buying, he will make a profit, else he will lose money. If the profit and loss is in the non-deliverable currency, you must convert it into the deliverable currency. That's it. Hope you now have a better understanding of NDFs for calculating profit and loss. Thanks for watching and happy learning.